Welcome back to Charged Alpha. Today we are breaking down Honeywell, ticker HON, fresh off a first quarter 2026 print that topped earnings estimates but missed on the top line. Adjusted earnings came in at $2.45 against consensus of $2.32. That is a 5.6% beat. Revenue, though, $9.143 billion versus $9.3 expected. So a classic quality beat masked by a slight revenue wobble. But the real story here is not this quarter. It is the pending separation that could redefine this 120-year-old industrial icon. Honeywell is splitting itself into two independent public companies, Aerospace Technologies on one side, Automation on the other. Advanced Materials was already spun off in the fourth quarter of 2025. That spin is why the revenue comparison looks weird. Quarterly trend went $10.35 billion, $10.4 billion, then down to $6.86 billion, now $9.14 billion. Shares sit at $214 and change. Market cap $136 billion. 52-week range between 185 and 248. We have work to do unpacking all of this. CEO Vimal Kapur has been with this company for 34 years. He is orchestrating the largest structural change Honeywell has seen in decades, and he is buying stock on the open market. Analysts are cautiously constructive. 9 buys, 4 holds, 1 sell, mean price target $228. Let us get into it. Cold open over, let us talk about the company. Honeywell traces its roots back to 1885. Today it operates through 3 reporting segments pending the separation. Aerospace Technologies is the crown jewel at 44.5% of revenue. Industrial Automation contributes 31.6%. Building Automation rounds out the mix at 23.9%. Each of these is a top-tier franchise in its respective end market. Aerospace Technologies serves commercial, defense, and space customers with engines, avionics, auxiliary power units, and connected aircraft services. It benefits from the global aviation recovery and rising defense budgets. Industrial Automation bundles process controls, sensing, and warehouse automation. Think integrated robotics, UOP catalysts, and performance materials. This segment rides industrial capex and warehouse modernization cycles. Building Automation delivers the controls, fire, and security systems that run commercial buildings. It plays into the energy efficiency retrofit theme and the data center build-out happening across the country. The strategic framework is called Honeywell Accelerator. It is a lean, digital-first operating system Kapur has rolled out company-wide to standardize execution, reduce complexity, and improve throughput. Accelerator was the precursor to the separation. Once each segment ran on a common operating chassis, management could credibly carve them into independent companies with aligned incentive structures. The Advanced Materials spin, completed in October 2025, created Solstice Advanced Materials as a standalone public company. That is why the fourth quarter 2025 revenue comparison dropped so dramatically. Post-separation, you will have 2 pure plays: a high multiple aerospace name with secular tailwinds, and an automation pure play levered to process industries, data centers, and warehouse logistics. Speaking of Kapur, let us talk about the CEO. He joined Honeywell back in 1989, 34 years climbing the ladder before becoming chief executive in June 2023. He ran the Performance Materials and Technologies segment, then Honeywell Building Technologies, before taking over as president and chief operating officer. That depth across segments matters for a separation-era CEO. His tenure has been about portfolio clarity. Within 18 months, he announced the Advanced Materials spin, executed it, and then announced the larger Aerospace and Automation separation. That is aggressive capital allocation. And critically, Kapur has been buying his own stock in the open market. Insider purchases from the chief executive right before a transformational split is a conviction signal investors do not often ignore. He is also sitting on restricted stock units that vest into whichever successor entities emerge post-separation. Alignment with long-term outcomes rather than short-term quarterly optics matters here. Now let us get into the numbers. First quarter 2026 adjusted earnings per share $2.45, beating the $2.32 consensus by 5.6%. But GAAP earnings were only $1.29. The gap comes from roughly $740 million in restructuring and separation-related charges. Those are real cash costs tied to splitting the company. Revenue missed at $9.143 billion against $9.304 expected. That is a 1.7% miss, driven largely by organic softness in short-cycle industrial automation. Let us look at the quarterly revenue trend. Second quarter 2025, $10.352 billion. Third quarter, $10.408 billion. Fourth quarter dropped to $6.86 billion after the spin. And now first quarter 2026, back up to $9.143 billion. The sequential rebound reflects normal seasonality plus the clean baseline now that advanced materials is gone from comparisons. Free cash flow for the quarter was negative $873 million. That sounds ugly until you remember first quarter is always a seasonal working capital build for industrials. On a trailing 12-month basis, free cash flow is $4.174 billion, revenue $36.76 billion, net income $4.117 billion, adjusted earnings per share $10.14. Margins tell the quality story. Gross margin 36.9%, earnings before interest and taxes margin 15.1%, net margin 11.2%. These are premium industrial margins. Balance sheet now. Total debt $33.64 billion, cash on hand $11.98 billion, net debt $21.66 billion. Net debt to earnings before interest, taxes, depreciation, and amortization is 3.31 times. That leverage is higher than I would like going into a separation. 3.31 times is elevated for an investment-grade industrial. Watch how debt gets allocated between the two new companies. On valuation, price to earnings 20.37 times. Enterprise value to earnings before interest, taxes, depreciation, and amortization 24.11 times. Price to sales 3.71 times. Price to book 6.38 times. The dividend pays $4.58 annually, yielding 2.14% at current prices. 14 consecutive years of dividend growth. That track record matters through a separation. Street consensus. 9 buy ratings, 4 holds, 1 sell. The mean price target sits at $228, implying roughly 6 to 7% upside from current levels before you add the dividend. Recent rating changes have been mixed but leaning positive. JP Morgan upgraded to overweight in January 2026, citing the separation catalyst. Wolf Research went to outperform in February. The notable bear remains Bank of America, which downgraded Honeywell to underperform back in November 2025. Their concern was separation execution risk and the potential for stranded corporate costs. Forward estimates show steady progression. Second quarter 2026 consensus is $2.55 on $9.73 billion in revenue. Full year 2026 estimate $10.52. Full year 2027 earnings per share consensus is $11.51. Full year 2028 estimate $12.62. That implies roughly 10% compound earnings growth through the separation transition. The key analyst debate is whether a sum of the parts valuation for the two post-separation companies exceeds the current combined multiple. Most bulls say yes, bears say execution frictions will eat the arbitrage. Some analysts have published sum of the parts models suggesting fair value somewhere between $235 and $255 once both entities are standalone public companies with their own multiples. Let us walk through the bull case. The biggest unlock is structural. Splitting into two pure plays should let each entity attract a natural shareholder base and trade on its own strategic merits rather than the conglomerate discount. Aerospace Technologies as a standalone should command a premium multiple closer to pure-play peers. Commercial aviation demand is strong. Defense budgets are rising globally. Aftermarket services generate high-margin recurring revenue. Industrial automation standalone plays directly into 3 huge secular themes: data center build-out, warehouse automation from e-commerce, and industrial reshoring driving new capex in process industries across North America. Honeywell Accelerator gives both successor companies a mature operating system out of the gate. That reduces the typical post-separation execution drag where newly independent companies struggle to stand up back-office functions. Kapoor's open market insider buying is a credibility signal. He knows these businesses better than anyone. 34 years of institutional knowledge paired with personal capital at risk tells you he sees value. The dividend track record provides downside protection. 14 straight years of growth means management is committed to returning cash even through the separation process. That appeals to income-focused institutional holders. Margin expansion runway is real. Current earnings before interest and taxes, margin of 15.1%, trails best-in-class peers in both aerospace and automation. Post-split focus could unlock 200 to 300 basis points. And finally, valuation is reasonable. 20.37 times earnings is a modest premium to the industrial group for a company with above-average margins, a clear catalyst path, and a credible operator at the helm. Now the bear case. The obvious one is revenue trajectory looks poor on a reported basis. Top line has been choppy quarter to quarter, and the first quarter miss reinforces organic demand concerns in short-cycle automation. Separation execution risk is not trivial. Splitting a 120-year-old company with shared infrastructure, shared customer relationships, and shared technology platforms creates real dyssynergies and stranded costs. Those separation-related charges of $740 million in the quarter are just the beginning. Management has guided to over $2 billion in total separation costs before both entities are fully standalone. The balance sheet concern matters. Net debt of $21.66 billion at 3.31 times leverage is high, going into a split. How that debt gets allocated will directly affect each successor entity's flexibility. Aerospace aftermarket demand is cyclical. We are deep into the post-pandemic recovery. If commercial flight hours plateau in 2026, services revenue growth decelerates right as aerospace technologies becomes a standalone. Industrial automation faces genuine competitive pressure. Siemens, Rockwell, and Emerson are all fighting for the same process control and sensing dollars. Market share gains are harder when everyone is modernizing their platforms simultaneously. The valuation premium is earned under a conglomerate structure. If the sum of the parts thesis disappoints, investors are left holding two average quality industrial stocks at average quality multiples. The upside math gets harder. And macro matters. Process industries spend less when capital is expensive. Building automation slows when commercial real estate stays weak. Separation does not shield the operating businesses from cyclical headwinds. Let us compare Honeywell to the peer group. On price to sales, Honeywell trades at 3.71 times with trailing 12-month growth that is roughly flat when you adjust for the advanced materials spin. Eaton trades at 4.2 times sales with 8.5% revenue growth. Eaton is the momentum name in the group thanks to its data center power and reshoring exposure. Premium is earned. Emerson trades at 3.8 times sales with 14.2% growth. That is the fastest grower in the peer set, reflecting its Aspen Technology software acquisition and process automation strength. GE Aerospace trades at 5.1 times sales with 11.5% growth. Post-split, GE Aerospace is the pure-play comparable for what Honeywell's aerospace standalone could look like. Rich multiple, strong growth. Parker Hannifin trades at 3.4 times sales with 4.8% growth. Parker is the most direct industrial diversified comparable. Similar multiple, similar growth, different segment mix. 3M trades at 2.8 times sales with 1.2% growth. 3M is the cheap, slow-growth anchor of the group. Honeywell is clearly above 3M on both metrics. Net takeaway on peers. Honeywell sits in the middle of the pack on valuation, but below average on growth. The separation thesis is specifically about closing that multiple gap toward Eaton and GE Aerospace. Options market is showing mild bullish positioning. Call skew is elevated relative to historical norms, with open interest concentrated in April and July. 2026 strikes between 220 and 240. That clusters right around the mean analyst price target. Implied volatility has also ticked up slightly into the separation timeline, suggesting traders are pricing in a real binary outcome around execution milestones. On the insider side, Copper purchased shares in the open market during the first quarter. Open market buys from a sitting CEO before a separation are rare, and historically they have been bullish signals. Other insiders have been net sellers, but that is mostly automated 10b5-1 plans tied to restricted stock vests. The signal to watch is the CEO buying, not the programmatic selling. Bottom line on Honeywell. This is a high-quality industrial franchise going through the most consequential portfolio change in its modern history. The first quarter print was fine. The thesis is not about quarters. The verdict leans constructive, but demands patience. Current valuation of 20.37 times earnings is fair, the dividend supports the floor, and the separation catalyst provides real optionality through 2026 and 2027. The bull case is that the sum of two focused businesses exceeds the current conglomerate value. The bear case is that execution costs, debt allocation, and cyclical headwinds eat the arbitrage before it materializes. For long-duration investors who can stomach separation period noise, Honeywell offers an asymmetric setup. For traders looking for clean momentum, there are better names like Eaton or Emerson in the peer group right now. The single most important thing to watch is execution on the planned separation timeline. Management has committed to completing the split within roughly 18 to 24 months. Any slippage materially changes the math. The other metric to watch closely is Aerospace Technologies' organic growth. Aerospace is the crown jewel, and the bullish re-rating story depends on that segment printing high, single-digit organic growth consistently through 2026. Mark your calendar for July 23rd. That is the second quarter 2026 earnings date. The consensus bar is $2.55 on $9.73 billion in revenue. The key performance indicator to watch on that print is aerospace organic growth. Above 8% confirms the secular tailwind thesis. Below 5% raises real questions about the aerospace re-rating narrative. Also watch industrial automation margins. The bull case requires margin expansion in automation to offset any aerospace deceleration. Segment operating margins need to show sequential improvement into the mid-teens. And the separation milestone calendar matters. Management has promised detailed capital structure plans for both successor entities by mid-2026. That disclosure will drive the next re-rating move in either direction. Watch free cash flow conversion too. First quarter negative $873 million was seasonal, but full-year conversion needs to stay above 90% to fund the dividend and any stranded separation costs. One last thing. Watch the corporate bond market. Credit spreads on Honeywell paper will tell you how fixed income investors are pricing the debt allocation question long before equity markets react to the same information. That is our deep dive on Honeywell International, a 120-year-old industrial icon in the middle of reinventing itself. If you found this useful, follow Charged Alpha and share the episode. A 120-year-old company reinventing itself. 3 segments becoming 2 independent companies. The sum worth more than the parts. Charged Alpha. We will see you on the next one. Charged Alpha is for educational and informational purposes only. Nothing in this episode constitutes investment advice, a recommendation, or a solicitation to buy or sell any security. All figures referenced are based on publicly available information as of the recording date and are subject to change. Please consult a licensed financial advisor before making any investment decisions. The hosts may hold positions in securities discussed. Past performance does not guarantee future results. Do your own research, manage your own risk, and invest according to your personal circumstances.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.